Ladies and gentlemen, thank you for standing by and welcome to the ZAGG fourth quarter 2019 earnings conference call. At this time, all participant lines are in listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question during this session, you need to press star 1 on your telephone. Please be advised that today's conference is being recorded. If you require any further assistance, please press star 0. I would now like to hand the conference over to your speaker, Brendan Frey. Thank you. Please go ahead, sir.
Thank you, Justin. Good afternoon, and thank you for joining us today to review ZAGG's fourth quarter 2019 financial results. On the call today, we have Chris Ahern, Chief Executive Officer, and Taylor Smith, Chief Financial Officer. Following Chris and Taylor's prepared comments, we will open the call for a question and answer session. Our fourth quarter earnings press release was issued today after the market closed at approximately 4:05 p.m. Eastern Time. As a follow-on to the earnings release, we published the supplemental financial information on our investor relations website, and we also furnished this document to the SEC on Form 8-K. You can find all of our earnings documents on our investor relations website at zagg.com in the quarterly results section under the financials tab. We are recording this call, and a webcast of the conference call will be archived at the ZAGG investor relations webpage under the events tab for 1 year. Before we begin, we would like to remind everyone that the prepared remarks contain certain forward-looking statements, and management may make additional forward-looking statements in response to your questions. These statements include, but are not limited to, our outlook for the company and statements that estimate or project future results of operations or the performance of the company. These statements do not guarantee future performance and speak as of the date hereof. For a more detailed discussion on the factors that can cause actual results to differ materially from those projected in the forward-looking statements, we refer all of you to the risk factors contained in ZAGG's annual report on Form 10-K and quarterly report on Form 10-Q filed with the Securities and Exchange Commission. ZAGG assumes no obligation to revise any forward-looking statements that may be made in today's release or call. Please note that on today's call, in addition to discussing the GAAP financial results and the outlook for the company, we will discuss adjusted EBITDA and diluted operating earnings per share, both non-GAAP financial measures. An explanation of ZAGG's use of these non-GAAP financial measures in this call and the reconciliation between GAAP and non-GAAP measures required by SEC Regulation G is included in ZAGG's press release today, which again can be found on the investor relations section of the company's website. The non-GAAP information is not a substitute for any performance measures derived in accordance with GAAP, and the use of such non-GAAP measures has limitations, which are detailed in the company's press release. And now I'd like to turn the call over to Chris Ahern. Chris?
Thank you, Brendan. Good afternoon, and thank you for taking the time to join us today. Our fourth quarter revenue increased 14% year over year to $190 million, which represents our highest growth rate in some time and a quarterly top-line record for the company. In terms of our performance versus expectations, full-year revenue came in just below the low end of our guidance range, while adjusted EBITDA fell short of our projections. It proved to be a more challenging holiday season than planned. Many of our retail partners experienced lower overall demand in our key categories, due in part to the shorter selling period between Thanksgiving and Christmas, and continued softness in device sales. To help drive sell-through, we increased our advertising spend and ran incremental promotions with several major accounts. While this had a positive impact on sell-through, it didn't generate the amount of replenishment orders that we had hoped, as many retailers chose to end the year with leaner inventory levels. We also experienced some cost overruns from our newly acquired brands and greater pressure from tariffs in the fourth quarter, as we were not able to fully offset or pass along the full extent of the price increases we had planned. In the end, the combination of higher spend, tariff headwinds, and an unfavorable channel and product mix versus expectations resulted in our EBITDA falling short of projection. Despite how the fourth quarter unfolded, there are a number of takeaways from 2019 that give us reason to be optimistic about our business in 2020 and beyond. Our three acquisitions, Gear 4, Halo, and Braven, which we acquired in late 2018 and early 2019 respectively, contributed approximately $83 million in revenue in 2019, up over 20% over 2018 levels. During 2019, we made great progress in significantly increasing distribution for Gear 4 in the US. Following a successful test in a number of Verizon doors in May, we rolled out to all of their locations in September. During the back half of the year, we also added doors with AT&T, Sprint, Target, as well as several others. We began 2020 with approximately 27,500 domestic points of distribution for Gear 4, compared to roughly 9,500 at the start of 2019. Over the past 12 months, we have also expanded and evolved Gear 4's product offering, launching new case designs compatible with several new OEM devices from Apple, Samsung and Google. Consumer response to the brand and its differentiated D3O technology has been very encouraging, and we are focused on continuing to build awareness among US consumers in the coming year. During 2019, Gear 4 gained 2 points in market share going head-to-head against established brands. We fully expect our market share to continue growing in 2020 and beyond. As we discussed in the past, the acquisition of Halo brought with it a great portfolio of power products along with a strong relationship with the home shopping network in QVC, a direct-to-consumer channel that ZAGG had not developed prior to this transaction. During the fourth quarter, Halo was regularly featured in QVC in sales, particularly for the brand of their boat lineup for vehicle starters were very strong. While this business has historically been quite seasonal, with the majority of sales events occurring during the third and fourth quarters, we are working on increasing the brand's channel presence during the first half of this year. During 2019, we also made headway securing sales opportunities for some of our other brands on HSN. For example, we launched a portfolio of iFrog's branded True Wireless earbuds and a Mophie Power SKU during the second half of 2019. Based on performance, we're looking forward to a successful relationship with HSN. While it is the smallest of our 3 acquisitions, Braven had a busy Q4 adding 1,100 new doors. In the fall, we launched an all-new rugged portable speaker product line featuring durable, shockproof and waterproof construction while delivering exceptional sound quality. These products have been very well received and we expect Braven's contribution to our overall results to continue to grow in 2020. In terms of our core business, our domestic screen protection market share is stabilized at approximately 45%, number 1 in the industry by a wide margin. Invisible Shield continues to lead the category through innovation. 2019's product launch was highlighted by the Glass Elite Vision Guard Plus suite of products that offers maximum breakage protection while also protecting the health of your eyes. Our newest innovation is an antimicrobial solution which is integrated into the screen protection and will continue to protect consumers against 99.9% of harmful bacteria for as long as the screen protection remains on the device. At CES in January, we announced that all future Invisible Shield product launches will feature this antimicrobial technology. Innovation will continue to drive the business forward in 2020 as we have a great product pipeline and that will further enhance the consumer experience and allow us to maintain and grow price points at retail. We've also seen good success with the product segmentation strategy aimed at addressing entry-level or value price points, which we implemented in mid-2019. As I mentioned, our screen protection market share has stabilized at approximately 45% since this strategy has been implemented. Internationally, our screen protection business is enjoying great momentum driven by the success of our ISOD strategy, in which we invested heavily during 2019. In 2019, we installed Invisible Shield on-demand machines in over 2,900 additional wireless carriers and retail doors across Europe and Latin America, bringing our global install base to over 6,200 units at the end of 2019. These productive new doors, along with additional accounts planned for ISOD in 2020, will continue to serve as a market component of our growth going forward. At the same time, we continue to work towards replicating the success we've had with ISOD overseas here in the US by expanding its availability beyond our current network of roughly 620 CPR stores and ZAGG franchise locations. In 2020, we plan to roll out a further 4,000 machines across 4 key markets: Europe, North America, Latin America and Asia Pacific, bringing our global install base to over 10,000 units. Mophie's year was highlighted by launch of several new products at Apple retail stores where we expanded our offering with a full line of cables and new wireless charging solutions, including 2 multi-device wireless charge pads designed to work with a variety of devices within the Apple ecosystem. We also launched a new wireless charging solution across most of our retail partners and we're very pleased with the sell-through we're seeing. In fact, the wireless products were so successful across our partner base and sold well above forecasts, which resulted in us chasing supply through the fourth quarter and into the first few months of 2020. Mophie ended 2019 as the number 1 brand in wireless charge pad category with a 31% market share. Midway through 2019, in response to the challenges faced by ZAGG and the industry at large, we implemented a series of cost initiatives in order to put the company in a stronger position and drive long-term profitable growth. They include 1. Reducing our global headcount by approximately 10%, 2. Accelerating some synergies from recent acquisitions, and 3. Decreasing the number of discretionary operating expense categories. These actions generated approximately $8 million in gross annual savings starting in 2020. More recently, we've identified opportunities to increase cost savings related to our 2018 and 2019 acquisitions and efficiency to deploy marketing spending globally, better leveraging our ISOD investments, and have invested in resources to help improve inventory forecasting and management. We expect a year-over-year decrease in total OPEX expense and improvements in inventory terms. We also announced last summer that the Board of Directors retained Bank of America Securities to assist the company in exploring strategic alternatives to maximize shareholder value. It was a very thorough and rigorous process during which we engaged with approximately 60 interested strategic and financial parties. We provided a thorough summary of the process in the press release filed earlier today. Based primarily on the challenges the business faced during 2019, which included softer demand for devices, the impact from tariffs, and a more than difficult expected holiday season, offers for the company were significantly below the current stock price. The board therefore unanimously determined that delivering on the company's long-term strategic plan is the best path to driving stockholder value. In the event we receive future transactional interest, the board would welcome the opportunity to evaluate any transaction that can maximize stockholder value. In 2020, our key priorities under the long-term plan are continue to drive innovation in product categories that address consumer pain points, execute strategies aimed at increasing market share in our core product categories, capitalize on the rollout of 5G in the second half of 2020 by launching innovative products that protect and enhance 5G-enabled devices, improve profitability through optimization of our operating expense structure, and improved inventory management. We feel we have the right long-term strategy in place to grow sales and increase profitability. That said, based on the past 2 years and how they have unfolded with several external headwinds beyond our control, and taking into account the current challenges and uncertainties being caused by the outbreak and spread of coronavirus, we believe at this point it is proven to guide a full year 2020 revenue consistent with 2019, with improved profitability to $48 million. Our objective is to exceed this target, and we look forward to updating you on the progress, especially as we get better understanding of the impact of coronavirus and visibility into the rollout and adoption of 5G become clear in the second half of the year. As it relates to the outbreak of coronavirus, it's obviously a very fluid situation that we continue to monitor closely. We have taken safety of our employees and our partners as top priority. This has resulted in a corporate travel ban to and from Asia, no country-to-country travel within Europe. Within the US, we have restricted travel to essential travel only, and we will continue to monitor this situation in the US closely. Our China-based team have predominantly been working remotely and have done a great job working with our manufacturing partners, minimizing supply chain impact in Q1. The biggest impact we currently see in Q1 will be an increase in logistics costs based on having to secure air freight, etc. Our 2020 outlook is based on what we know right now, and we'll provide updates if anything changes in the future. I'll now turn the call over to Taylor, who will review the financials and guidance in more detail.
Thanks, Chris. Since many details of our quarterly financial performance were included in the supplemental financial information issued earlier today, I would just like to take a few minutes to add some additional comments on our fourth quarter financial performance. Q4 net sales increased approximately 14% to $190 million, in line with the low end of our guidance range. The year-over-year increase was driven by increased sales of protective cases under our Gear 4 brand and increased power management sales driven primarily by Halo product sales and new Mophie wireless product launches during the second half of 2019. These increases were partially offset by lower sales of screen protection and power case products compared to last year. At the beginning of 2019, we estimated our newly acquired Gear 4, Halo, and Braven brands would grow by approximately 10% over 2018 levels. It was great to see these brands grow by over 20%, and we expect solid future growth in the years to come. Gross profit as a percentage of net sales remained flat, though we saw upside from an increase in sales of Gear 4 cases and Halo power products. These improvements were offset by increased duties from products manufactured in China, a decrease in sales of our screen protection products, and a shift in our channel mix. As we mentioned on the last earnings call, there are several levers we've attempted to pull to mitigate the significant increase in tariffs that we've experienced in 2019. Those levers have included 1. Negotiating price reductions with manufacturers, 2. Passing along tariff increases to customers, 3. Purchasing inventory in advance of tariff increases, and 4. Exploring the movement of manufacturing out of China. These efforts were largely successful during the first 3 quarters of 2019. However, given the significant increases that went into effect late in the year, we struggled to offset a significant portion of the tariff increases, which impacted both our gross profit as well as duties capitalized into inventory during the fourth quarter. Although we did achieve cost downs with our factories, many of those price reductions were not realized until late into the fourth quarter. In addition, due to the competitive nature of the categories that we compete in, we found it extremely difficult to pass along the duty increases to customers as we had originally projected. As we look into 2020, we're pleased that the Trump administration provided a waiver on our wireless charging products and in mid-February further reduced tariffs by 7.5 percentage points on a number of our categories, including Mophie power stations and juice packs, Invisible Shield film screen protection, Gear 4 cases, and Braven and iFrog's Bluetooth speakers and headphones. Although these tariff decreases, combined with the cost downs achieved with our factories, will provide some relief from the tariff increases in 2019, we still expect tariffs to be a margin headwind throughout 2020, which has been incorporated into our 2020 guidance. Q4 operating expenses increased 20%, or approximately $7 million, compared to last year, due primarily to the full quarter impact of Gear 4 and Halo operating expenses, including some unanticipated cost overruns in the fourth quarter. Increased marketing investments to support second-half product launches, as well as to drive sell-through of our growing portfolio of brands, products, and channels during the holiday season. And last, additional investment in our Invisible Shield on-demand infrastructure. These increases were partially offset by a company-wide restructuring, as Chris mentioned, that was executed during the third quarter of 2019. Q4 adjusted EBITDA was $31 million versus $28 million in the prior year period. Although we saw growth compared to the prior year, Q4 results fell short of our expectations. The key drivers that impacted adjusted EBITDA relative to guidance included some unmitigated tariff increases, product and channel mix shifts, and operating expense overages, particularly with our newly acquired brands. Despite these headwinds to profitability, we're confident in the strategy we have in place and expect 2020 to be a year of adjusted EBITDA margin improvement. Turning to the balance sheet, compared to a year ago, accounts receivable decreased 9% to $143 million, and DSOs improved significantly from 87 days to a more normal level of 69 days. Despite some headwinds from increased terms internationally and with key U.S. customers, DSOs benefited from the timing of sales during the fourth quarter of 2019 versus the prior year. The quality of our receivables remains very good. Inventory was $145 million, compared to $83 million at the end of 2018 and $138 million at the end of the third quarter of 2019. The key drivers of the increase in inventory were 1, incremental inventory associated with our acquisitions, 2, duties and freight capitalized in inventory, 3, inventory growth for international markets to support that growing business, and 4, some excess inventory linked to the decrease in demand for handsets in the U.S. Despite the increased inventory position, the excess SKUs are largely current product, which has helped mitigate some of the tariff impacts during 2019 and alleviate some of the supply chain constraints in China due to the coronavirus. Consolidated inventory turns excluding capitalized duties and freight was approximately 5 times, down from 7 times in the prior year. We expect to get back to approximately 6 turns by the time we exit 2020. Net debt, which is consolidated debt less cash, increased to $89 million compared to $43 million last year. The increase was due to cash used for the Halo acquisition of approximately $20 million, $1 million for share repurchase, and the remaining to fund ongoing operations, including expenses associated with our newly acquired brands and second half 2019 tariff increases. With regard to our free cash flow, our priorities have consistently been to service our outstanding debt, repurchase stock, fund tuck-in acquisitions, and last, support internal growth initiatives. Given our recent M&A activities and 2019 business headwinds, our focus for the next several quarters will be on paying down the debt to give us flexibility down the road, including the ability to opportunistically buy back our stock in the second half of the year. Our year-end gross debt was $107 million, and until it's below $100 million, we are prohibited from repurchasing stock under our existing credit agreement. During 2019, the board approved a $20 million stock repurchase authorization that is still active with the entire $20 million available for future buybacks. We'll revisit our capital allocation as we move through the year. Last, I wanted to spend a few minutes discussing our guidance for 2020. As Chris mentioned, although we were confident in our strategy and expect 5G technology to contribute a long-term uplift to our business, given some of the macro uncertainties that could impact the business, particularly in the second half, we have decided to take a more prudent approach to guidance in 2020. We are forecasting 2020 net sales flat with 2019. The key assumptions built into this guidance include increased first half sales from our core business and the recently acquired Gear 4 Halo and Braven brands, offset by challenging comparisons in the second half, combined with some uncertainty related to the impact of 5G technology in 2020 and the potential impact of the outbreak and spread of the coronavirus, which has created a fluid situation both from a supply perspective in China and a retail perspective in the rest of the world. We did experience some delay in our Chinese factories coming back online in the first quarter after Chinese New Year, but have good line of sight to delivering on the vast majority of the customer demand during the quarter, though we'll incur approximately $2 million in incremental expedited air freight charges during the quarter. Our current guidance is based on what we know now, and we'll provide updates if anything changes down the road. Gross margins are currently estimated to be in the mid-30s as a percent of sales, roughly flat compared to 2019. This takes into consideration product cost downs at factories and product category mix improvements, including a higher mix of screen protection and cases, offset by a full year of the increased duty rates and the additional air freight that I mentioned. We estimate our annual tax rate at this time to be approximately 25%, and we'll provide updates as we progress through the year. We estimate 2020 diluted earnings per share to be approximately 50 cents on approximately 30.1 million shares outstanding. Adjusted EBITDA for 2020 is estimated at $48 million, or approximately 9% of revenues. This assumes an overall reduction in operating expense during 2020 as a result of the restructuring activities during 2019, as well as other cost-down initiatives. One important call-out in our business model: any incremental sales and associated margin above our current guidance would come with very little incremental operating expense, and therefore the percentage flow-through to the bottom line would be very meaningful. While we don't typically provide quarterly guidance, given the number of moving parts and that we are more than two-thirds of the way through the first quarter, we wanted to share some specific details to help you understand the change in our year-over-year performance. We currently estimate Q1 2020 sales to be in a range of $90 million to $94 million, compared to $79 million last year. We're projecting Q1 adjusted EBITDA to improve to negative mid to low single-digit range, compared to negative $9 million in the first quarter last year, with further improvement in the second quarter versus the prior year period. With that, we will now open up the call for questions.
Thank you. And as a reminder, to ask a question, you'll need to press star 1 on your telephone. To withdraw your question, press the pound key. And again, ladies and gentlemen, that is star 1 if you'd like to ask a question. And our first question is going to come from Mike Maloof from Craig-Hallum. Your line is now open.
Great. Thanks for taking my questions. If I can just talk about Invisible Shield first. It sounds like you've maintained market share for a couple of quarters now. Can you just give us a little bit of insight into what's going on with that market, and how attach rates are going? Are you seeing attach rates go down a little bit? Just kind of an overview of what's going on with the Invisible Shield market would be helpful. Thanks.
Yeah, thanks, Mike. So firstly, in terms of attach rate, year on year, Q1, we're actually seeing our sell-through quite strong. It's showing over last year. So demand is clearly there for the product. And I think what we've done from a segmentation perspective is really helped to solidify our market share. So, for instance, being able to capture the value price point, but also be able to attain the higher MSRPs with the Invisible Shield brand. So, all in all, we're very happy with how the segmentation strategies played out, and we're seeing the demand reflect that in Q1 as well.
And what would you say is your average unit price difference between, say, at the end of 19, given some of the changes you had, versus, say, the end of 18 or even the end of 17? What would you see as the average cost per shield?
Yeah, a good question, Mike. It's gone down slightly, but I'd say it's not materially different. I think what the strategy has enabled us to do is hit some of those lower price points, which, although not a terribly significant portion of our overall sales, has just allowed us to maintain the share that we were at. So, overall, it's probably a couple of dollars of total sell-in, but still fairly consistent with what we saw last year.
And we've maintained our gross margin percentage as well on that segmentation.
Yeah.
Okay. And then just on inventories, it looks like you had some continued sort of pressure there, and you sort of gave a list of 4 things. I'm just wondering if you could just give us a little bit more detail surrounding the specific on the duty side.
Yeah, it's a good question. So, as part of inventory, any freight and duties that you use or that you pay to bring the inventory to your location and prepare it to sell gets capitalized into your inventory. And so, if you kind of compare year over year, And this is a combination of both some increase in inventory and then also the rate increase with the tariffs, particularly in the fourth quarter. Capitalized freight and duties increased by a little over $20 million. And so, if you compare kind of where we were at with Q3 with where we ended in Q4 on a straight inventory perspective, we're actually down, but obviously we're up because of the capitalized freight and duty. So it was definitely meaningfully contributed to the increase in the fourth quarter as far as inventory goes.
Okay, and then just one final question on the acquisition strategic review process. You said that you had, I think if I read it right, you didn't get any bids that were above the stock price. One, is that how I should read it? And then two, perhaps you could provide just maybe some insight into what the acquisition or what the acquirers or potential acquirers were what the thought process was, if you got any feedback.
Yeah, so I would say, Mike, you read it correctly. That's how you should read it. In terms of the potential buyers at the time, some of the concerns are mainly around the uncertainties around tariff. We had a more difficult holiday season, some softer demand. All of those combined didn't help within the process, and they were some of the key concerns. And then obviously towards the back end of the actual process itself, as we got into February, coronavirus didn't help either, but I would say not the key differentiator, but didn't help in terms of this instilling confidence.
Yeah. Okay. Thanks a lot for taking my questions.
Thanks, Mike.
Thanks, Mike.
Thank you. And our next question comes from Thomas Forte from D.A. Davidson. Your line is now open.
Hey, Tom.
Thanks for taking my question. So the first one I had was with the tariffs in 18 and 19, and then more recently the coronavirus, how should we think about the long-term role of China as it pertains to your supply chain?
Yeah, so I would say for us, the way with the tariffs and all new products going forward, we're designing the products with the tariff in mind. That's not to say that we're looking at alternative supply chain or CMs outside of China. We have one or two CMs already where we're doing trials, but ultimately it's going to take some time. So for us, the key is to continue to drive costs down on the product, but also develop a product with tariffs in mind. Hopefully that answers your question.
But is there do you think that long term you'll diversify your supply chain to be less dependent on China?
Yeah, for sure. But just going back to my second point, that's going to take some time. So I would say over the course of the next 12 to 18 months, we'll see some diversification, and primarily in some of our larger type categories is where we're going to be doing that. So for instance, wireless charging, we've already got a pilot ongoing in Vietnam where potentially we can shift production to it. But yeah, we will be diversifying on production sites.
And then my second question is, so when you talk about the again, thinking about the coronavirus and then projecting the flat sales for this year, you talked about the current state of the supply chain and how you may have some incremental costs as far as air freight. But does that mean that trying to stabilize there? And then also, what are your thoughts from is that also maybe forecasting in potentially soft demand for some of the geographies that have been hit harder? So is it a combination reflection of supply chain and potentially demand softness?
Yeah, so let me approach it in two different ways. So we'll start with the actual supply side. So, we've been very fortunate that our team really got ahead of it in Q1, Tom, whereby we were able to secure the vast majority of our demand, our products for Q1. So in Q1, we're not seeing a major impact from it. However, as we progressed, particularly over the last 2 weeks, we have seen demand softening in our international footprint in particular. So for instance, Italy, as you would expect, is on lockdown. Lot of impact from less retailers going or less consumers buying in retail. We're seeing some softening in other areas as well. So what we've done is we see good line of sight to Q1. We have a decent line of sight to Q2, whereby we are seeing some softening in demand in our international space, but we ultimately felt it prudent that we cannot tell you what is going to happen from the end of Q1 onwards. It really is down to the coronavirus and how it's impacting in our footprint from a retail perspective. But without coronavirus, I will tell you the first half we got some good line of sight to our possibilities of distribution. So it's really the unknowns in the second half, and that's why we felt it prudent to keep the revenue flat.
So last question. I think for Invisible Shield, you had the last year was about protecting consumers from harmful blue light, and this year I think you have some antimicrobial elements, which seems like your timing there is really fortuitous. Can you talk about that, and can you talk about your ability to keep that product in stock?
Yeah, so lucky or not, it was very fortuitous, and we've seen really strong demand for that product. We've been working really hard with the supply chain to make sure that we're able to service that. I will tell you we're in a little bit of catch-up mode with that, and that's primarily because of the IP and being able to integrate that solution into our screen protection. But we've good line of sight to be able to capture a majority of it in Q1, and we feel strongly that we'll be able to do it in Q2 as well. But yeah, the product is proving very, very popular with both consumers and our retailers.
Thank you for taking my questions, Chris.
Thank you, Tom.
Thanks, Tom.
Thank you. And our last question comes from John Hickman from Ladenburg. Your line is now open.
Hi, John.
Hi. Can you, in the past, your revenues have fallen about 40% in the first half and 60% second half. Is that still how you see the year, given, your uncertainties?
Yeah, it's a great question, John. If you would have asked me 3 weeks ago, I would have very confidently told you we were kind of 37, 38 front half, with the balance, in the second half of the year. Given what's, kind of transpired over the last 3 weeks and what we've seen in Italy and other parts of the world, I think there's probably a shift, based on flat revenue guidance, and what we're already seeing, some nice growth in Q1 and a pretty good line of sight to Q2 that, based on flat revenue, we'd probably see higher sales certainly in the first half than we have historically. And as Chris mentioned, part of our guidance in the second half is just the uncertainty with regard to coronavirus, and then also, obviously 5G. We expect that to be significant from a long-term perspective. It's just very difficult given all the other things going on in the macro environment to be able to accurately predict that, which is why we've guided flat.
Okay, and then can you explain to me again why the higher air freight costs? Why are you air freighting instead of on the water?
Yes. Yeah, so all of our factories, kind of at the end of January, they send their workers home for Chinese New Year, which is, typical with Chinese factories. The return of the workers was delayed by the Chinese government because of coronavirus, and because of those delays, production has been, somewhat delayed with a number of our categories. And so, in order to get the product here to meet customer demand, it's required us to spend some more on air freight to be able to get the product here on time.
Okay, I get it. Thank you. Appreciate it.
Thanks, John.
Yep, thanks, John.
Thank you. And I'm showing no further questions. I would now like to turn the call back over to Chris Ahern, CEO, for closing remarks.
Thank you all for joining us for this quarter results. We look forward to updating you in our next call.
Thank you. Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now disconnect.